Testing, testing. Are we live? I believe so. Welcome back, everybody, to the Prospero.Ai stock market live streams. Hope you had a great weekend. Thanks for joining me here. It's 11 a.m. Monday morning, August 19th, and the markets have all opened just a bit higher this morning. QQQ is up 0.29%. The SPY is up 0.4%. Dow Jones is up 0.5%. And the IWM is actually leading on the day, up 0.56%. So good to see. As the people are rolling on in, please like the stream. Thank you for joining on Twitter and YouTube. We stream on both Mondays at 11 a.m. and Wednesdays at 3 p.m. So thank you all for tuning in as always. Let me see some of those familiar names in the comments right now. I'll take you guys through some of the topics that we're going to get into today. Before wrapping up the stream with the model portfolio update at the end. We don't have Matt here today, so I'm going to be leading the newsletter discussion, but we're going to be covering Prospero's performance. We had recently had a big boost from just about 35% beating the S&P 500 for 2024 on an annualized basis to almost 100%. I believe this morning when I looked, we're about 96% beating the S&P year to date, again on an annualized basis. We'll go through the mindset and the philosophy that investors need to have when performance starts to lag and maybe you go through a rut like every investor does. And it was shared in our newsletter actually, but we'll be going through that. And then we'll take a look at the current state of the market. Let's look at the S&P and the QQQ net option sentiment quickly as we're starting here today. They were in bullish levels last I looked. QQQ all the way up to a 59 net option sentiment. So looking strong for the QQQ. Good to see. Looks like more bullishness to come. And the SPY is at 56. So that's a change we're noticing right now. The QQQ is now higher in net options in our net option sentiment signal than the SPY this morning. So interesting change we've seen there. We're going to update everybody as George rolls on into the stream. Hello, George. On ASDS stock, which has just been on a crazy tear recently. We'll share everything you need to know, maybe if you're not in stock, if you want to get involved, if you should or not at this point. Then we have AMD acquiring ZT Systems. We'll tell you how much and what it means for the AMD as a stock. Then we have Goldman Sachs lowering their recession odds. We'll tell you what they are forecasting the USA economy for the rest of the year. And also, which is a little contrary signal we have to share today, is gold, the price of gold hitting an all-time high. So what does that mean for the market going forward? We're going to dive into that topic. We have a few more. Carl Icahn, who's well known in the stock market and investing world, just got charged by the SEC. We'll tell you what for and what it means for IEP. And then on this date, 20 years ago, a little company you probably or maybe have heard of it, Google, went public. The performance over the past 20 years, we'll share just how much, which is an insane percentage. It's in the thousands. And what the state is of Google today. And then last but not least, we have two more topics. A judge temporarily blocking the Warner Bros., Disney, and Fox Sports venture into a all of them coming together streaming platform for sports. It's not blocked permanently, but as for now, a judge has ruled against it, and Fubo stock actually ripped off this news. And then ending the topics of the stream today, we have Jackson Hole with Powell speaking on Friday. And should investors be listening to it, or is it just more market noise? We'll dive into that. But George, as I shared with our loyal viewers when we started the stream, Prospero.Ai performance on an annualized basis over the S&P 500, after kind of going through a little bit of a dip, I think we were down as low as 35%, has now roared back, pushing 100%, just below it. I know in the newsletter, there was an analogy shared to the mindset that investors need to maintain, kind of similar to poker. But if you just want to take maybe some of our viewers who didn't read that, what you shared in that newsletter update and how you were able to generate that performance.
Yeah, the analogy was playing on tilt, which, for those that aren't familiar with poker, the it's basically letting your emotions take hold of you and making bad decisions, especially if you've, lost hands. Um and it's a really good analogy, as we pointed out, in terms of just in the same way, money's on the line, your emotions get a hold of you, especially if you've lost money, and it can cloud your judgment. And what we said, like, kind of cliff notes is, if you haven't had a losing streak yet, God bless you. It's coming eventually. And when it does come, you're going to have to, you know, face some tough music and ask yourself whether you were just lucky or whether you actually had some process that was working that stopped working. And that process could stop working temporarily. It could have, like, as I said, been luck. There could be elements of it that work now and elements of it that don't, that you have to sort through. But the first thing that you're going to have to do to get out of it is start being more conservative. And it's the same thing in poker and investing or trading. I think it's really analogous, because when your emotions start to take hold of you, you are not able to discern what is logic and what is emotion very well. No one does this very well. No matter how good you are at, understanding yourself, your profession, anything, emotions get the best of all of us. Um, so that's why you have to start being conservative again, so you can separate out what are your good ideas and what might be emotional responses to losses, right? So, we had to go through this process, and there were parts, as the performance was going down, there were parts that were reaching a little bit in terms of, trying to make those gains back, maybe doubling down on tech and large cap tech a little more than we should have, given what was happening in the market. But there's a fine line between, kind of sticking with your bread and butter and what's made you money. There's a funny thing that I said, that I was always said to my younger sister as she was learning to play fantasy football, a lot later in life than me, and she would ask me who to start, and in the playoffs or late in the season, and I would always just say, you got to go with your horses. Go with your horses. Go with who got you there. And that's another kind of funny analogy where, yeah, to an extent, you have to stick with what what made you successful at anything. But in any of these things, you also have to know when to adjust, revise, make new strategies. So that's what it's really about. How we kind of got back to the basics and then saw kind of an obvious win in the Trump Bitcoin trade that, started to build us back. And we actually doubled and tripled down, you might say, as Bitcoin was going down, because we did have conviction in that idea. That was something where we said, no, I don't think this is an emotional response. And I actually knew it wasn't an emotional response because I never invested in Bitcoin. And I never think it's a good idea. So the fact that idea, like, just because, not because I'm a Bitcoin hater, I always say there's non-transparent options markets. If you want the longer answer of that and haven't heard it yet, I'm sure you could post that in the questions, but I'm sure a lot of people have gotten my longer answer on that enough times. But anyway, so that to me was saying, no, if I actually, like, if I'm actually seeing a lot of the logical groundwork for this, especially around me thinking that Trump was going to say positive things when he spoke on Bitcoin, that was kind of like the slump buster, where we took on risk, but we took on risk for what we thought were the right reasons. And then we kind of just, like, layered it on, got back in what we, a good headspace, where I was differentiating between, good risk and bad risk again, which is pretty much the key to investing. Like, if you're going to make any money, be just playing the market, you're going to have to take on risk, and you're going to have to identify what are good calculable risks and bad risks, that are kind of ill-conceived. And there's a lot of game theory in that. So I think that's kind of the basics, and we always talk about confluence. One of the things that really was great for us here is we were observing, QQQ net option sentiment kind of being volatile, overly volatile. But when we really loaded up last week again on risk, not only did we see a lot of things in individual stock names that we liked, we also noticed the QQQ net option sentiment was stabilizing far past where it was. And there was like a tweet we shared. If you go to our X page, you can basically see it. It's also at the top of the newsletter. We kind of like summarize what we were seeing in the QQQ and what gave us that conviction. And yeah, that, what was conservative, just kind of like slump busting moves built into some major gains again pretty quickly. And believe me, like just like anyone else, I was saying in about 3 weeks, I went from 81% above the market to 35%. And then in another about 3 weeks, back up to 100%. And, people might say, well, aren't you taking on too much risk? And I would say, we do take on risk. We do take on a lot of risk. And that's why when people copy our trades or want to copy our trades, I say, like, this is a process that's good for me. Like, I wouldn't recommend it for anyone. I'm not going to stop you, but everybody has to find their own process. And there's risk in that process for sure. And anytime you can find yourself 100% above the market, you could find yourself, losing a lot of that ground pretty quickly. So it's just a question of, what got us here. And obviously we're very consistent, right? We were about 50% above the market the last 2 years and more this year around that, at times around that level, now back up more. But that doesn't mean there's not going to be volatility even in our portfolio. To get those kind of big wins, you're going to see big losses too. And the most important thing is when you have those big losses to not not look to make it all back in a day or a week or anything. Like, a lot of, I think I like kind of the analogy. I always like to use sports analogies, and it's kind of like that. If you're trying to hit a home run, you're going to strike out a lot more. If you're trying to just make good, solid contact, you're going to hit home runs and you're going to, bat for a higher average. And that is, I think, how we look at things. I'm just trying to hit, and, some people will say I move out of positions too fast, but that's just because I'm comfortable hitting singles, grabbing the singles, hitting them. If I'm not confident that the signals have stayed where I wanted them to, I'll take those singles. And for people that have more time, I would encourage you to have more of that attitude, especially as we use the signals. But yeah, that's kind of a long answer, but I think it's an important lesson.
Yeah, and I think from what I understand, risk and reward are kind of linked in the stock market, and it's impressive to see the performance with the level of volatility in the market the past few weeks. But I wanted to update investors that watch our stream on a stock we talked and covered last week, ASTS, which I think we talked about it last week, Monday and Wednesday, and it had a 50% move in a single day last week. It's a stock that was trading at $2 as recently as May, and now it's well over 30. So maybe if people haven't gotten in this stock yet, do you think it's too late? And just what is your view on ASTS after the move we've had? And we covered the potential last week, but just your current thought process on ASTS.
Well, I wouldn't say it's too late, but if I were to play it on my own going into this like mid-September launch, I would be owning my shares and buying puts. That's what I would be doing. We don't own options, so I'm probably just going to stay away from it just because like that kind of volatility, we don't like it. And we did get out of it on Friday just because like when a stock has, and if you go look at it, it's got like 90 option sentiment, 90 social sentiment, and 90 short pressure, 90 dark pool. Like I think all are above 90 or around that range. And when you get that much activity in everything, you could pretty much just like toss out all of those signals. And that's why I sold on Friday. The price action looked like it was about to go the other way and did, but then it's swinging back. And who knows, it could be the other way tomorrow. That's the tough thing when the signals get that high in everything, right? Because there's options bets, there's dark pool, there's a lot of people betting a lot of different ways in the short term, and there's no guarantee, and a lot of downward pressure too. And what you have to remember about shorters is, on a stock like ASTS before the launch, I'd bet on them winning, right? Because a lot of these shorters at some point, like, I'm not saying like winning permanently, driving to zero. No, I bet on them winning based on like getting the stock down significantly. Because like what you have to remember is a lot of shorters on a stock like ASTS are actually interested buyers that just think that the stock got a little too high in price. They'd rather own it at a lower level going into the launch, or maybe after the launch, because maybe it's not, maybe they're a little worried about the risk and they're just loading up on shorts and saying like, hey, maybe I'll buy some call options too, just in case I'm wrong. Kind of the reverse of what we talk about as a typical meme stock trade, because there's a lot of value here. But yeah, it's very like, unless you know how to employ like options to de-risk on your own, that would be the only way we could find ourselves into recommending ASTS right now. Like, and we're, putting it ourselves. Yeah, I know, Gabe. That's the thing. Like, part of me like kicks myself when we get out of something like that, even though we got up when it was up like 7% on Friday, and so it's like, and then it ended up down 1%. So we're only 10% behind. But yeah, I could easily see it finish the day down based on the way price action has gone for it. So just too volatile for us right now. Too volatile for us. It's probably too volatile for a lot of investors. But hey, that doesn't mean there isn't potentially money to be made. Like, there absolutely is potential money to be made.
Yeah, and it seems like it'd be impossible to time a stock like that that's moving that quickly perfectly. But let me ask you about this, because it seems like, ASTS might be a little too nuclear to get excited about at this point. There's not many companies that do similar things to them. One of them is Rocket Lab, which has a ticker RKLB. Would that be an interesting like halo effect type play if ASTS continues to rise and gains that, social media popularity that we see in Prospero, that investors could look to like cheaper, plays, and there's not a lot in the market available?
For our real-time ASTS watchers, I just took a look. Net option sentiment, actually, after being above 90 earlier today, is down to 84, and short pressure is up to 98. So it's just like we're talking about. Like, and just, yeah, before I jump into Rocket Lab, one more thing to kind of put a bow on this. Like, you have to ask yourself, like, who's shorting ASTS as it goes up, and what do they know? They could be wrong, right? Obviously, you're doing this, but like I said, I don't like, on a stock like this, I have a hard time not seeing it lose a chunk of this ground. Um, just because it's like, you gotta remember, it's now a 10 billion market cap stock on what, $700,000 in revenue. Like, that is not, we're pretty far away from value at this point. And it's great to own growth stocks, but there's just not much holding the bottom of this if things start to, go down. I mean, other than a successful launch, but until you know if that launch is successful, it's hard. Or it might get delayed, and it might get just like hammered on a delay. But Rocket Lab, I find less interesting, just because, I mean, it always kind of looks not great in Prospero. I'll take a look. It's like RKLA, something like that, right? RK Rocket Companies, RKLB was
Yeah.
close. Oh, I mean, it's actually looking pretty decent. It spiked to 88 net option sentiment. Yeah, so it looks like people are playing it. Like, it definitely is getting a sympathy play. But I still just like, yeah, I'm still just not sold on like a secondary player in this. Like, what did you do much research on like what's actually happening with their satellites, the revenue projections? I mean, I'm always so bad at like monitoring. Um,
No, I was purely bringing them up as like, the psychological aspect of like investors just seeing ASTS going up and then trying to like benefit off a similar type of thing. I feel like people do that a
this is what
lot
I
in
always
trading.
okay. Check this out. And like Sage Tracker, God, I hate advertising for Webull. Webull has great research products, even though please don't put your money in there. They're just like Robinhood, only they're not even American owned. Um, and 0.72, Steve Cohen's hedge fund sold out at $4.84. D.E. Shaw, very famous quant fund, sold 95% of their position at 484. Interesting, same price. I wonder if there was a conversation that took place between those funds. Um, yeah, anything, nothing, no one else that I would consider like high leverage. I mean Citadel and like let's see, like sorry, I should be more specific. High leverage, like volatile traders. Like when you look at like Schwab or even I saw State Street, Citadel, I even saw on sell side, those people buy and sell stuff all the time just to balance, right? When you look at someone like 0.72, 2 Sigma, that's the kind of like D Shaw, volatile leverage traders that are going to be moving. Jane Street did buy it at 487, kind of similar, like kind of more similar, not as large of a position, but like, yeah, that's what I look for, like in lieu of research, right? I would have loved to like do a deep dive, look at all their things, like blah blah. It looks pretty good in Prospero. But if you ever want to do like quick and dirty, like I wouldn't call it value, I'd call it value adjacent. Because again, you're looking at like another source other than Prospero, which is like doing kind of some of the same things, but obviously we see net option sentiment jump. So part of what I'm trying to say is like get rid of that noise. Let's see on the institutional level who likes their business and who doesn't. And like 0.72 didn't like their business at $4.84. DE Shaw didn't like their business at $4.84. It's trading at like 692. That right there is probably enough to kill my research, unless I saw some interesting like high leverage names buying on the other side. But there's a little hack for you, how I do value research quickly outside of Prospero.
Yeah, that's a great tip. And although we don't seem to like that stock, maybe we'll like this one better. And we're about to talk about AMD, and with how much we talk about AI and chips and tech, I'm surprised that I feel like AMD doesn't come up that much. But they acquired a server builder, ZT Systems, for $4.9 billion today. Um, I think an interesting way to, after we talk about AMD, is kind of, the AI chip landscape. What are your top five currently, and does AMD make that list?
Um, it depends. If you're talking about pure chips, like SMCI is not considered, it's considered like a server play, not a chip play. But my camera losing focus. It's always something. Um, do you see the camera losing focus? Do I need to twist? Like, I think it's fine. I think it refocused, right?
It's good. Yep.
Okay. Um, so let's see. I think right now for risk reward, Broadcom's our number one. We just bought it again, sat at the top of the screener. Like we like Broadcom. Sorry, Nvidia fans. I would put like Nvidia number two right now, just because I mean earnings is coming up. They could go big over earnings, but it's we always talk about it. Like if they even grow just by like 180%, and this is the last quarter where they'll be piling on top of kind of old results before the AI boom. The really interesting one is going to be the quarter after this, where they're looking to grow on top of 200% growth. So yeah, I think that um, I think that that's where it's going to be most interesting. But all right, so let's keep going with the list. I would say after that, like on pure, like this is where it kind of gets tough on like what's, because like if you're talking about like anything chip adjacent, I think you're gonna say see SMCI above that as well. I also just like generally, I think for because they're lower risk, I like ASML and LRCX above those. Like Taiwan Semi is out of the top 5, I would say, like, but just there, just because it's like such a solid company, but there's geopolitical risk around it. And then AMD would probably come in at 7. Um, just because I mean they're a great company, but they kind of don't have the huge upside of Nvidia, SMCI, the safety of Broadcom, um, and just like that same base core business. And then like I'd say similarly, LRCX, ASML, I like them because they don't have the geopolitical risk of even American chip companies, right? When you're looking at Taiwan Semi, when you're looking at AMD, you're kind of exposed to the same, like in the case of Taiwan Semi, more geopolitical risk. AMD, you're exposed to the geopolitical risk of like tensions with China. But ASML, LRCX, you don't have that. And I actually just want to check, make sure I know ASML, I think it's a Dutch company. But what is, before I say it's safer, we might have I thought it was, oh no, LRCX is American. I misspoke. But I do still think I'm gonna take a look at it. We're gonna take a look at it versus AMD, see if we want to redo the rankings, taking a look at live. Yeah, so we're talking about LRCX is a 77 upside, 36 downside, 91 profitability, 68th growth. We're looking pure long-term signals because that's what we're doing. Yeah, AMD is 56 upside, 40 downside, 61 profitability, 73 growth. You're getting a little more growth, but you're just not seeing that same institutional confidence as you are in LRCX. So much institutional confidence, I labeled them as a non-American company because I assumed there wasn't with much better ratings like that. That's higher upside than Nvidia. Nvidia's flashed to like 82, I think someone told me, but I think it's back down a little bit. But even that kind of volatility and upside is exactly what you see with Nvidia being risky. Okay, so that's our official top 5. Broadcom, Nvidia, Supermicro, ASML, LRCX. And then if Taiwan Semi didn't wasn't in Taiwan, and if it was even a US company, it would probably be above LRCX. But as good of a company as it is, too much geopolitical risk.
Super interesting list. I'm wondering if our viewers are surprised by any of the stocks that made it. So comment now. But just a side note before we move on from this topic, I feel like you covered the whole market in its entirety, but I feel like investors always kind of like get drawn to a certain sector, and for each investor it's a different one. Do you think that like AI chip is your kind of like bread and butter in the market, and it's so like a sector that you know the best?
I would say tech broadly. And I always kind of advise, I like even people that I'm training as interns or whatever, I always advise them and anyone learning value investing to go with what interests you, go with what you know. Like part of why tech's good for me is I've been interested in tech for a long time. I've studied it for a long time. I've studied AI. I've studied the interaction between like AI and hardware. And so all of that is just very natural for me to analyze these companies. And even just like i actually did um I actually did a long time ago a macro research project. I worked at a macro fund one summer, and there was this like Taiwanese pearl company, and I was asked to do like geopolitical research on naval tensions interrupting the pearl supply. So it was just a notch below war. This was like 20 years ago, about 19. So I've been studying the geopolitical tensions in that space, and I actually studied the historical like the historical impact of that as well on this Pearl Company research. That's what like that is the interesting thing about Wall Street. Sometimes you could be studying a Pearl Company and ending up looking at a history of military tensions. That's like deep value macro research right there. Um, but yeah, like tech interests me. So I'm reading articles like that in my on that in like my free time and like learning about it and like my news feed and everything. So like I'm always learning about that stuff. Like one of the reasons that we don't take major bets in energy. And a lot of the times I'll go long short energy for this reason. Cause like I know people that know way more about like the geopolitical situations involved in energy and supply and demand and things like that. And that's just not something I'm super well versed in. And you can't be well versed in everything. Like, yeah, we cover the whole market. We definitely know how to diversify when there's risk, and we have methods for picking energy stocks, even though it's not my core competency. You know, we've done some really good things in utilities this year, both long and short, more so than energy. Um, but yeah, I think that the important thing, you know, when we talk about this, not only like leverage what you're interested in, leverage your profession too. Like, and it could be anything. Like if if you work at like Walmart or Target as a cashier, like you could have insights into consumer spending based on like, the flow, how expensive the goods are. Like you have like ground floor value research. So it doesn't have to be like you don't have to be like, a doctor with insights on phase 3 trials that can help you invest in biotech. Like that's like an obvious example. And there's, everything in between. You could be like, you could be a supplier of, you could be someone who owns someone that's like owns a car part supply company. And you could basically be seeing a lot more EV stuff coming through, and that could form a thesis. Like, anything in your life is value investing if you know how to frame it the right way and add research in the right way and figure out how to direct it towards stocks or sectors or anything like that. I've just been interested in tech for a long, long time. And I got my first laptop when I was in 5th grade, part of a laptop program that my school had. That was we were the first year that did it. So after that, other 5th grade classes got it. But I had this big thing and had a 14.4 modem that was like still dial in. And like, yeah, when you guys see me with the model portfolio and like typing all that, that's because I was taking computer typing classes when I was in 5th grade, and I was using office programs for that long. And basically like, did everybody that was in that program have they become good tech investors? No, right? I had to take those foundations and my knowledge of computers and the path of technology and turn that into a method for researching stocks. That was interesting to me. And like I said, I did on my own time, even when I wasn't, working on stock predictions, which was many years of my career. I wasn't working on stock predictions, but I was definitely still following tech.
And I think that's what the Prospero signals do so well for investors is give you confidence and insights into areas of the market that you may not know so well. And with the V recovery we've seen in the market, it seems like Prospero was hinting at that early. We just got a new piece of information today. Goldman Sachs cut their USA recession forecast odds from 25% to 20%. And they cited the data that we got in the retail sales and jobs data from last week. I was wondering, that 20% number that they give, is that something that you would feel is about right, or would you disagree with that? And yeah, go from there.
Well, I trust Goldman Sachs's recession prediction over anything that I could put together. Like I that sounds about right. Like, but it might just be confirmation bias from hearing what they do very good work. And I would say there are some banks that I think like smaller ones. The larger ones these days, I wouldn't say are playing this game as much, but like will use their public like speaking um around their positions. But like when these banks get so big, like I'm not saying Goldman Sachs wouldn't love to juice their positions, but like at any given time, I doubt David Solomon, the CEO of Goldman, knows even exactly what to say that would do that. It's so complex. And you don't even know if your high frequency traders are out there in a day going like more net short than you knew. And you could end up like, granted, there's a lot of moving parts, and they very easily could say like, hey, you better say something like the overall like chief investment officer who's ever watching the portfolio or whatever could say, hey, we're pretty short today. You might want to say something, you might want to say something a little more bearish. But even that, like that's kind of a small score for a place like Goldman Sachs, like day trading, saying something bad about the market. If they're ultimately like wrong because they were too bearish, like their reputation is everything and they're trying to be right. Granted, like how that fits with a 25 versus 20 recession, like, that's when you're making those tweaks. I'm just like much more inclined to say they're trying to be as accurate as possible than there's any kind of like horse in the game one way or the other. But you never know. You never know with these things. But I'd say the good way is kind of just like looking overall at what people would say. And I mean, I think the other thing is we're just defining recessions in our own. I think I think was like last year around this time, I think we had 2 consecutive quarters of negative GDP, and they were just like, we're just not calling that a recession, like, or because there was job growth or something, like these days, it's just like it's very hard to get a straight answer out of everybody, in the world's changing a lot too, right? A lot of growth is coming from AI, and like there's big things with cost of goods, and like I was actually reading like a perfect example of this. I was actually reading that I think like I forgot how long ago, I think maybe it was like 30 years, that the median income for home buyers, like, and this was like adjusted for time, was like 59,000, and now it's like 106,000. So like that does tell you how different of an economy we have now than has been in the past. We're just in a new world. So yeah, maybe we'll have another like recession that isn't a real recession. But no, I mean, I think that's the thing. We've got inflation, really under control. There are some signs that it's like starting to slow down the economy, but not a lot. Like we had one job reading, then bad job reading, and then a few good ones. So, I don't really think that there's evidence that we're really slowing down the economy enough to really hurt GDP that much, especially because I do think some of this automation is creating more GDP that is not necessarily as closely associated with labor as it traditionally would. So I think that's going to be an interesting thing to keep an eye on, especially as we see if it's a recession or not. Um, but yeah, like Goldman does a lot of hard work with a lot of smart people to produce that number. So you're gonna rarely find me disagreeing too hard with them, unless they're like saying something about you know retail investors. I disagree with a lot of what large banks say about retail investors, or anything about David Solomon's DJ career. I think I disagree with that on principle.
Um, yeah. So before we get into our next topic, we have had close to 1,200 people tune into the stream today between Twitter and YouTube. So thank you everybody for stopping by. We have some comments to get to. Someone on Twitter is asking, no Prospero for PC. I guess we could update him if it's coming soon. And then Gabe on YouTube is asking about ASPN stock. Net option sentiment headed down. Time to take profits.
Yeah, I mean, we got out of it. So yeah, like it was too volatile, like too unpredictable. Net option sentiment heading down. I will say about ASPN that I do see some volatility in net option sentiment sometimes. But yeah, like I never that stock did me dirty. So I say get if you can get out of it with profits, like I say run for the hills if net option sentiment is going in the wrong way. Um, And yeah, like we have other important things on our roadmap, like our trade alerts and like our enhanced Discord channel. So Prospero for PC will be an early 2025 thing, but we do have a design for it. It's in our Discord channel. We've shared it a bunch of times there. If you want to join the Discord, I can post it, and I'm sure you can see. I'm sure you could see it again.
All right, so hopefully he'll join the Discord channel. But as you're getting that in the chat, I'll bring up this next topic, which is a confusing one for me because if I'm correct, gold pricing hitting all-time highs and the gold price soaring is typically a concerning sign for stocks since it's kind of like gold is like a rush to safety. But we have that occurring right now. So should investors be reading into the gold price and how it's hitting all-time highs, or is it just more market noise?
I mean, gold isn't what it used to be in terms of like, yeah, I think people used to rush to gold when they were worried about the market. But now I think with like the media cycle and like people are kind of like perpetually worried about the market. And like there's the perma bears out there. And I just don't think, I don't like, and if you look at the chart for it, it just kind of goes up, 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 right? So I think basically like it's just not what it was. It's not what it used to be. It's not like, oh, the market's going to go down, like we got to rush to gold. It's honestly just like the thing that kind of just always goes up. I'm looking at it and you don't even really have the same kind of slumps as you do with the market. Like there's some, but like obviously when the market's slumping, like it's good if the market's going down, it's good if the market's going up. But like I am actually reminded of something as I say that. I still don't love it as an investment. I still like other like rare earth metals. I like better than gold. For one, just because there's kind of like a practical use. But I've given this Ray Dalio quote before. And basically the Ray Dalio quote is that it's very hard to make money in something that everybody's already making money in. And it's like, priced into that, there's not the same upside in that, but there's significant downside if there's ever a correction. And people say, maybe this is a gold bubble and it goes down. There's a lot more risk in something that just goes up, up, up than there is reward. That's always kind of been my philosophy on that. I think it's a good point by Dalio, and it's like it's the same thing with a lot of different things. Although I'll tell you the difference between like gold and Nvidia, right? Gold is what it is. It's not like unless they find some new application or product that it's going to be used in, and I don't know when the last time that's happened. I think it's consistently used in some, not like groundbreaking or anything like that. That might send it, but Nvidia could crush earnings again, and send the stock up a lot. Like gold doesn't have the equivalent, which is why, if you want something that's, going up, 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 right? But has the potential, Nvidia's got risk and reward. There's just a lot less reward in gold as I see it than there is something that's going to like report earnings, can keep like growing rapidly. But the flip side is it does keep gaining. I just like, it's hard for me to look at something like that, look at a chart and say it's never going to have like a big correction. Like every asset that goes up, up, up has a correction at some point. I mean, I'm looking at, you could argue it's had some, but yeah, I do worry about, longer term, if there might not be some kind of correction coming for it.
And we got another, I think this is a really interesting question from D Curtin, because if I'm not mistaken, last week we just showcased this for the first time. but he's asking any future ideas to add some sort of net option sentiment recent average, so we could see where net option sentiment stands versus where it's been.
Yeah, so we've started to release. This is going to be part of like our trade alerts product that we're relatively close to releasing. But in our paid investing letter, in our paid and more often in our paid trading letter, we've started to publish here. I can kind of like pull it up. We've started to publish our net option sentiment movers, like our. I'll pull it up on the screen so you guys can see. So yeah, if you subscribe to either of our paid letters, the trading letter, we're trying to do it like most days. But yeah, it's right here. These are like, oh, it's not gonna. These are basically our bull and bear ones. So like, yeah, you'll see here, we're looking for the biggest declines from the 1-day average to the 7-day moving average, and then raises. And then we also have like these filters where we're making sure upside and technical flow are above a certain amount to like de-risk it. But yeah, we've started to put this all together in our trade, and it's going to go into our trade alerts product.
So good question, D. Curtin. A way for us to bring that up and showcase it on the stream. That's great. We have a few more topics to try and get through. We have Carl Icahn, who is probably a familiar name for most of our viewers. I think he's a multi-billionaire. He's recently been charged by the SEC for failing to disclose pledges of company securities as collateral for billions that he took in personal loans. So not looking good for Carl Icahn. We'll see what happens with him throughout the process of, if he goes to jail or not. But it's kind of interesting because I think you've mentioned on the stream before about how much like CEOs and a lot of the wealthy people take like loans on their stocks that they have in equity. And I guess he just didn't disclose it properly, or, was doing too much, or I don't know.
Yeah, I was gonna say that I didn't even know you had to disclose. So I'm kind of proud for the SEC for actually like monitoring this stuff. And yeah, like it would be stupid for people, like that's why when people are just like, oh, like this or that or the other thing, it's like CEOs, anyone only sell stock when they want to sell stock. Like the bigger your company is, if you're talking about like a market cap that's any bigger than like, a couple $1 billion, like you have the kind of liquidity, and banks like don't mind taking your stock as collateral for loans because they're getting interest on those loans. Stocks are liquid, right? And they're just stocks are great collateral versus anything else, because also like, think about someone giving you a loan normally, right? They can check your bank statements, blah, blah, blah. They can check all that stuff. Like, but they don't really know if you've like burned through all your money, if you've lost your job or like whatever. They're just like taking that risk that that's not going to happen. You're going to keep paying. If they have stock as collateral, they know how your wealth is doing. Like, and they could very easily like ask you, and I'm sure there's covenants in a lot of these loans that if the stock moves, they could call the loan. So they could basically like force you to liquidate your shares unless you pay them back a certain amount based on like, things like, so it's just very, it's a very easy thing to loan against. And again, there's really no reason like, and to make a different point, just because a CEO wants to sell some of their stock doesn't mean they think their own company is bad or the stock's going to go down. It is perfectly reasonable to sell stock as a risk management principle, to say, hey, just like I don't want all of my wealth exposed to this stock. I want to diversify into the other assets. But that's just what we're saying. Like if a CEO or whoever had full confidence that the stock was going to keep going up, they wouldn't need to feel the need to diversify. So there is some at least light level of concern if you want to de-risk, if you want to broaden, right? It is sound investment practices, but like some people, and it's always like, I think the people that just like love whatever stock that we're talking about, that say, oh, like you gotta like pay for their kid's school or like whatever. No, never that. These people all have access to cash if they want cash. They're not like paying the bills like you. That's you like applying your life to them. They don't have the same life as you. But yeah, it's interesting. Like, you wonder what's going on there. Like, I don't know. I would have to like read more about these disclosure laws. I obviously just found out that they existed. But it would seem a pretty interesting, a pretty like it would seem a pretty obvious thing to comply with and easy to comply with if you're aware of them, which I'm assuming he was. So the question is, what else is going on? And the what else is going on could always be like, part of what we're telling you guys here is that like people like love leverage, right? It's good to, instead of just like, selling stock, having cash, paying for things, leverage is just like all forms of different kinds of debt instruments. And the only thing that's coming to mind that you have to like report this leverage is like, as a person, you're only allowed to lever yourself up a certain amount. So if you didn't report these loans, it's quite possible it could allow him to leverage himself more in other areas. And that's the only reason I can think of. But like I said, it's like, it's possible like they didn't know all the reporting requirements or whatever. This is not something I've ever heard of. But yet I've heard of like, for a long time, you hear of CEOs just basically like not wanting to do it because you avoid personal taxes too, right? And that's the other thing that we always say: when you liquidate, you're also paying taxes on that. So not only does this leverage allow you to keep money in company stock if you want, you're also avoiding a tax bill by not liquidating stock, paying yourself cash, paying in taxes. So that's the other reason that we always say you're paying taxes that you wouldn't otherwise have to liquidate that stock. So it does probably mean you see some risk in owning it, or it
So
definitely does.
today's date, August 19th, 2024. 20 years ago today, a little company we all know called Google went public. And over those 20 years, its shares have gained 7,600%. And I think the story today, is perfect way to bring up the point of, long-term thinking in the stock market with, there's been a lot of negative stories around Google recently. I'm sure over the course of 20 years, there's probably at least a negative story every year, and yet it's gained 7,600%. So if you were just riding your winner in Google that whole time, that's the kind of performance you would have got. And there's stocks that are just going public or small companies today that will have that type of performance over 20 years from now. So I think we could just bring this up and talk about the long-term mindset an investor should have.
Yeah, I mean, I think and back to what we were talking about earlier, that's what I love about tech. Like tech, if you research it well, it's the only thing I know of that gets you those kinds of returns. And like, there's tech adjacent. Like, you can look at Amazon, even though Amazon, Tesla, they're consumer cyclical. Obviously, they use a lot of tech for their business. So like, I struggle to think of a company that's had hyper growth in any recent time that wasn't at least heavily tech reliant. It probably exists, but it's not coming to mind. But I think looking at Google, and one of the things we were going to just like talk about the state of Google, I've talked about them much more confidently in the past than I would today. And I don't really own, it might be one position in my trading portfolio, but as much as I like their like brain technology, in terms of like the actual like, deep mind, tech that I think puts them, pretty much ahead of a lot of companies in terms of just like pure processing ability of data with something that's smart. They're not seeming to productize it that well. And I'm also seeing like some chinks in the armor. Like, not only is it just like weird that despite having that brain, they're not really catching up to Claude or Chat GPT in terms of just like how much people like using it. That is like when it came out, I was kind of like, oh, I think they could use this brain, but to like create a product, but they're not really doing it. which is interesting. And the other thing I would say about Google is like when I knew people that worked at Google when I was younger, it was like a badge of honor. And only the top people went to Google, and even they like had certain like grades requirements. It was a very like elite thing to be there. Now, you can make an argument that any company that grows, they're going to have to like widen their hiring practices. But the thing that I would say about Google um, that has changed is I just don't see the same excitement. Like I'm running into more and more people that are just like, yeah, I work at Google. It's not the same excitement, pride, what have you. And I'd say that's the bigger difference than people changing their hiring practices. It's gone from a place that everyone I knew was super excited to work at to a place where, some of the people I meet that work at Google are excited to work there. I mean, I meet more and more people that work there just because as a result of they've gotten so big. But yeah, I'd say that's the biggest change. I don't think it's the same badge of honor to say I work at Google that it once was.
That is a really interesting point to make about the current state of the company and the culture, kind of that companies are built by the people within them. So if the people aren't excited to work there, the growth that they're going to be able to generate isn't going to come. So very interesting point to make. We have a story that sent Fubo shares flying higher, but it didn't really affect Disney, Fox, or Warner Bros. That much. I guess they're much bigger companies. But a judge has temporarily blocked the joint sports streaming service by Warner Bros., Disney, and Fox. It's going to be called Venue if it ever gets to be released. But for now, it's on pause. But it was crazy. Let me get a live look at Fubo. But it was up 25% this morning off this news. But it's one of those small stocks that's gotten crushed. Let's see if it's been able to hold on to those gains. Wow, it went up as high as 38%, and it's back down to 25%, so still up. But what do you make of this story? And I guess the market has showed its hand. If this venue service is able to actually, if it's not blocked and this, judge ruling gets overturned, it seems like Fubo is going to get hit hard by that, and maybe that'll be the final nail in the coffin.
Yeah. And I mean, I think that's a big difference in the market today and what it was before. I think, whether it's the bots or whether it's retail traders or some combination of both that are just like, pushing each other along, there's just so much more, kind of momentum trading in the market where it's just like, if you look at it, it's like, all right, there's, there's a definite story here, and there's some possibility that this streaming service like is going to not go through. I wouldn't bet on it. Like a lot of these times I just feel like it might be show just being like, oh, like because there's so many monopolies that are like unregulated. I feel like sometimes like the DOJ is just like, we care about stopping this, but like I feel like most of them end up going through in the end. It's just like it's just like it's just like a like it's not, they don't stop you from making more money, like they just make you pay for it, right? In legal costs. They just be like, all right, we're just not going to make this easy for you, but like it's probably going to happen. But like regardless whether it happens or whether it doesn't happen, I don't think Fubo is going to be the winner here in streaming sports, right? And that's why I talk about momentum trading. Like where it's just like, I think more in the old days, you didn't see this kind of thing because you had people look at it, you're just like, is Fubo going to win? Like, no. Like, so we're just happy to keep owning Fox or whoever, like whoever we think the winner in streaming sports is going to be. But in like this day and age of momentum trading, I'm sure you have these high frequency traders, they see a news event, they get into what it's going to be, they might load up more, and then who knows when it collapses. But I think that's the perfect. I was actually asked about, I did a Twitter space with Wolf on last Friday, and someone asked me about Fubo, and it had gone up even last Friday. A good advertisement for net option sentiment. I was like, maybe you could play it to 65 net option sentiment. It's definitely up from where it was, but it still had an 8 upside. So I think that's exactly what we're talking about here. Just like using the Prospero numbers instead of me, like where it's just like nobody really likes it long term. and yet people are just like loading up short term because they know people play these events. And that's where it's just like, I hate that retail plays these events, because like you do hear about people that win on these, but like ultimately, like institutions are going to win so much more than retail on these, because robots are getting in early. They know exactly when it's starting. And as we mentioned, if you're at, especially if you're a broker like Robinhood or Webull, like even if you're putting in your order at the right time when the stock's starting to go in the other direction, these places can still jump in front of you in an automated way when they see that the tides are turning on pricing. So the deck is completely stacked against retail on these momentum plays. Like the nice thing about using something like net option sentiment, right? That's getting you in more with the earlier bets, right? You're basically seeing before the price moves when people are starting to change their options bets, and they change their options bets before they change their stock bets, because those are the higher profits, those are the biggest leverage. So before they, start, they'll buy a bunch of puts on something before they start selling the stock or short selling the stock. So that's why it's a really helpful tool. But even that, there's just, you're going to do way better like not playing pure momentum things if there's some kind of like, ASCS is the perfect example. Like, why play pure momentum when you can play something with momentum that has like a real lasting business that has a high chance of winning in the end? That's always our philosophy. Like, we don't mind playing things with shorter term theses. We just want to make sure it's a good long term business too, to help us de-risk it. And Fubo is not that.
Okay. So last topic before we do our switch over, we have the Jackson Hole meeting this Friday where Jerome Powell will be speaking. Are you excited for it? Are you going to be listening in closely to what he says, and how important is it for the market, moving forward after he speaks?
Yeah. First of all, I'd love to go to that someday. It looks like a great. Looks like a great time. A lot of that. That's a tough invite to get though. But basically, uh, the interesting thing about like, I think you said a few years ago there was some big move from it. The interesting thing about whether it be stocks or anyone in the public domain, and I've definitely seen it happen before, where if you make some kind of statement, right? Powell's had a few cocktails, he's mingling, he says something about rate cuts that was not public before. He basically has to, like, if he's playing by the rules, he basically has to come out the next day when he talks, or his next municipality. Sometimes, even if sometimes there's like a release of like a public company disclosure or whatever. And that's just basically someone at the company, their lips got a little too loose, and like you have to immediately disclose it. Like, I'm sure in Powell's position, it's not the same as a public company, but like I imagine, like at something like Jackson Hole, if he says something that's new that people didn't expect it, he probably said it to someone before that and needs to say it to everyone else to be like compliant with his job. The one thing that comes to mind, I don't have any like strong, like it's hard to know what happens because companies make disclosures all the time because they want to, because they're excited about things. It doesn't have to be because like someone had like loose lips. But I do remember like one time when I was following AMC, and Adam Aaron, their CEO, basically said that they were not going to dilute anymore during that year. There was a statement that came out after, and he said there was going to be a statement. I don't think that was like a loose lips scenario. Like he was planning that the whole time, and the statement came out shortly after. But basically, like that's the idea. I don't know how many people know that, but there's a rule that you can't share non-public information. And, I don't know the exact laws around like the remedy of that, but I do know, like, I don't know if you say something and then you immediately like publish it. If there's something else, like someone could have like damages on you in between when it's published and when you said it, like, but I don't think that really happens. But yeah, basically when you call, and I've talked to a company's investor relations, I've talked to CEOs when I was on the buy side. When you talk to them, they really only have certain things that they can tell you. The really nice thing about talking to them though is um, it takes away some of the hunting that you have to do when you're building a model or you're understanding the company. Like you could ask them, like basically what ends up happening is you're just like, oh, like I'm wondering about this like acquisition you made. Like, how does it like how do you model it? Blah blah. Like, and then they'll like a lot of times they'll be like, oh yeah, when we first made that acquisition in this filing, we said the revenues and like the way we track it on an ongoing basis is by looking at this number. That's what you get when you um when you talk to the company. But even that is just very, very helpful versus like trying to like do it. And like, when you talk, like sometimes they're just going to highlight certain things. Like they'll say, like, you could just be like, okay, like for you, to hit your higher revenue targets this year, like what are you going to have to do? Right. And then they'll kind of like a lot of the times they can say, what product lines would have to do well and that kind of thing. And that's where you're actually getting like some information that you might not get, but that's not considered non-public information because they're speaking to you in hypotheticals, right? That's one thing that they can do. Like they can be like, oh, like if this went well, this and this would likely have to go well. They're allowed to say that like once you get them on the phone, and that's not necessarily filed. But that's also not public information because they're speculating and they're very careful about what they say on that kind of thing. And sometimes they won't say things like that just because they're like very, very tight-lipped. And honestly, it depends on how much they want to help you out. But yeah, that's kind of the interesting nuances. But it is, I will say this, I do think it is very good that we have a system that doesn't allow for that. Like, yeah, like people like it's possible, like, one of the things I always talk about is like, famously, like you can play golf with a public company CEO and you can ask them if they're going to beat earnings and just the look on their face, what it means, right? That's not illegal, right? If they wink at you, like it depends. This is murky. Like if they wink at you and maybe someone grabs a video of that whole situation, it's possible they could go down for that. But if you're just like reading their facial expression, like you can imagine there's a lot of leeway there. Where like if someone tried to sue them for that, they could just be like, what facial expression, right? Like he could read it one way, you could read it the other way. You're not gonna get in court for that. But at the same time, like anyone who's been around anyone and asked them a question before, like you could tell a lot about what your question is, even if someone doesn't answer it. And when we talk about access, that's really what that's really what like a hedge fund institutional world gets you, like just access to people. And access to people is just like more information, more data, even if it's not anything that skirts any laws.
On that note, I believe it's time to do the switch over. And with the market looking bullish, are we going to have a bullish George today in the Prospero.Ai laboratory?
I think we'll see.
All right. We'll have to look at the signals in there.
Yeah, we'll have to know what's going on with QQQ and SPY and option sentiment, but I'll see you in there.
Yep, see you in there. So that's why the viewers are going to have to stick with me, and you'll have to see what George is seeing in our data and signals, and what moves he's going to make. We have 1,500 people that have tuned into the stream today. So if anybody is new, what we're about to do is the model portfolio update. So George will make moves live, so you get to see what stocks he is cutting, adding, long and short. So very interesting. We're going to take a live look at the QQQ and net option sentiment. When we looked at the beginning of the stream, the QQQ was at 59 and the SPY was at 56. So let's see if they are still at those bullish levels. All right, so the QQQ is at 58, so slightly lower, but remaining at a firmly bullish level. And then we have the SPY at 55. So both of them lost 1 point in our net option sentiment readings, but still firmly in the 50s, which, if you're someone who pays attention to Prospero signals, is a strong recovery from where they were just a few weeks ago. The net option sentiment charts for both the QQQ and the SPY are both in clear uptrends now, which is good to see. And, the market is having itself a V-shaped recovery from that Japanese yen carry trade little panic sell we saw a few Mondays ago. But the market is invincible. As Davey Day Trader would say, if any of you guys have watched him, stocks only go up. So, but we'll see how George is feeling when he comes back in here. I hope you guys like the topics that we covered today. I would love to know what the favorite topic we covered of yours was in today's stream. So feel free to comment that as we are waiting to see George in the Prospero.Ai laboratory. And feel free also to comment any stocks that you want him to give you a live look at how the signals are and how he's viewing them. Love to see Topher in here, D. Curtin, Gabe, a lot of familiar names. So thank you for tuning into the stream as always. Right. And we are back.
I think what we're going to need, I think what we're planning to do today is to finally take a look at trimming this. Trimming the portfolio a little bit. So I'm just taking a quick look at where we're at. Man, I feel a little dumb about not at least keeping I wanted to grab
ASTS.
those links.
Is that
yeah. Okay, so what we're gonna do here is grab the sectors. And then we're going to start sharing. Okay. Here we go. So we want on exit. I guess we'll do shorts first. On exit positions. Do we have the sector in there? No, we don't. Okay. So that's there, and then we want okay, we're going to do okay. Now we want to get
So first we have 116. Yeah, see, 116 versus 91. Yeah, we really wanted to do this cut. All right, now we want to do this. Actually,
We got a question, or really a statement from Mario about Prospero doesn't seem to have stats on IWM. Is there any symbols related to it that Prospero does track? We've covered this before, but
yeah, you wanna tackle that?
yeah. So it's just that the components of the IWM, Prospero needs to have a certain percentage to share reliable stats, which is why like the SPY and the QQQ we have, because all those are big companies which we cover. But the IWM has some small stocks that aren't in Prospero, so we can't show reliable data on it. So that's the explanation there. But you could look up individual stocks within the IWM. Some of them will probably, I would say most of them actually would show up. It's just some of them that won't.
Why is it? Why is it doing that? We're gonna shortcut this one more time. All right, that is going to be. I believe that should work too. Yes. Okay, now we're cooking. And then oops. All right, see, that's fine. What stands out to me is we have a lot of tech here, but that may be okay given where we are with QQQ net option sentiment so high. But what we are going to do, we're going to move all this to a different sheet. All right. So now we're basically looking what's on the bottom here. And I think are snow and app wins?
So snow, is that a short?
No, these are longs.
Snow is not popping up for me.
In longs?
Yeah.
It's right there. It is a win. But I think just like taking out some of our SMCI, maybe one of our Z-scalers. Let me take profits on one of these. Is AXP a win?
Are we in the trading portfolio or the newsletter right now?
Trading. Trading.
Okay.
This is, yeah. AXP?
Yeah. I'm trying to.
Okay.
I'm looking for it. My computer's not working right now.
Okay, no problem. Where were we? Okay. Yeah. I think we're gonna do a is Apple? Oh, you can't do it.
Yeah, sorry, I don't know what's going on. It's just not loading.
Can you tell me what app's doing in the signals?
Yes.
Net option sentiment. Yeah. And then no.
App is uptrending. It's currently at 79. Clear uptrend.
How about snow?
Snow is at 91, also uptrending and also towards the highs of the trend.
Okay. So I think that.
Snow has earnings this week. I know that.
Oh, let's just get out of it then. Reducing the exposure. Okay. It's a little less overweight in there now. All right, that looks good. Any sectors we don't like? Anything not looking good? I mean, energy is a little rough, but I think we have more short and long. Yeah, I think we're good there. And I think the only other thing, I think we're going to do that. How many we get? 3, 4, 5, 6, 7, 8 tech reduced. Okay, let me just do one more scan. Fine with that. Fine with that. Any other opportunities? Oh, actually, let me just make my life a little easier. And we can do one. I didn't do this. Just get rid of MSTR. That's not in good shape. Oh, we missed this. Our pan west. I kind of want to keep that for Pelosi. Oh, CDNS is not. Let's get out of it. See, I'm glad we looked at this. These were like sneaking through. How about Intuit? How's that looking?
Intuit is at 64. Pretty volatile trend. It goes between 11 and 74 throughout it.
Wait, what stock was that again? Sorry.
Intuit.
And then say what you did about it one more time.
It's currently at 64, but the trend is very volatile, like spiking all the way down to 11. Has a high of 74 throughout it.
Okay. So let's see. We want to just get out of basically just our worst consumer cyclical. That's changing a little bit, especially given today. Oh no, sorry. It would be this. What is it? What's going on with CHH? I'll just do one of you.
CHH is at 56. Neutral trend, but it's also volatile between 14
What about
and
LEA?
65.
What about LEA?
LEA is at 55. It's uptrending from a low of 5 that it hit August 14th, but it's hasn't made new highs yet. Low 50s throughout the trend.
All right, I think this is everything we want. Well, just let's look at PAG actually. PAG. We're gonna stick with it. This is gonna not be our nicest design.
So Buffett cuts Apple and we cut tech. Our portfolio, we think we may have gotten a little too loaded up on tech. So we'll cut some of our larger positions. As well as tech that is lower in our signals. On the short side, consumer cyclical is clearly coming on the last few weeks, so we do not want to be more short than long there. So we'll trim 3.
All right, there we go. We are done.
Okay, let's see. No new comments. So thank you, everybody, for tuning in to today's stream. We'll be back Wednesday, 3 p.m. to catch you up on everything going on in the markets. But until then, happy investing, and we'll see you there. Thanks, George.
Great. Thank you.